You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean only one thing. It is Education Wednesday here on the old OIRN, what the cool kids call the Options Insider Radio Network. That means it's time for a double dose of your educational content, kicking it all off today with your favorite far and wide Options Bootcamp, the program for you, the busy and perhaps a little bit concerned these days retail stock trader. Maybe you're looking to dip your toes into those options waters. Maybe you've already taken a few dips into the options pool. Maybe you didn't like how it turned out. You want to improve it. We'll be your lifeguards here in the old options pool. Maybe you're one of those legions of Robinhood traders and Webull and everyone else who are discovering options for the first time these days and driving a lot of flow out there in the options market. Either way, we've got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network member. If you like what you hear, not just for this program, but for everything we're doing here on the network, make sure you keep those reviews coming on your platforms of choice. A lot of you have done so, and it has continued to drive new people. Like we said, there's a lot of new people discovering options right now. A lot of them have questions. And so it's helpful for them to be able to turn to their outlet of choice. Could be an Apple Podcast or whatever it is, Google, Stitcher, Spotify. New ones all the time. Amazon Music, just adding our stuff not too long ago. And having a place for them to turn to. We've been doing this for a long time. So we like to think we know what we're doing and maybe we're a little bit good at it. At the very least, we'll keep you engaged and informed, maybe a little bit entertained in the world of options. So keep those reviews coming so new folks can continue to discover this program. I see it all the time out there, how many people are discovering this show. And it's heartening to see in these troubled times. So we want to keep it out there available for you guys. Options Bootcamp. And of course, later today, you also get a little dose of Options Playbook Radio as well. So a lot of education coming your way today. And of course, holding down my Options Bootcamp drill instructor squad's co-seat with me today, the black-hatted one, Mr. Passarelli, out on assignment today. So we've got a newcomer, at least to this program. He's my old buddy from the Option Block show, Mr. Uncle Mike TOSAW from St. Charles Wealth Management. Uncle Mike, welcome to the program. I hope you brought your drill instructor hat and whistle today, sir.
Move it, scumbag! Let's do this!
Yes, voices the whole show. That's what I want. I forgot to tell you that ahead of time. We're going to do voices the entire show. Can you handle that?
I'm up for it. I can't wait. I love this.
Well, Uncle Mike, it may be hard to believe you've been on the option block with me for so long, but there are quite a few new people discovering shows like Options Bootcamp who may have never heard the option block in their lives, which is, by the way, if that's you, you need to check out that show every Monday and Thursday. Just subscribe to the full network. You'll get everything out there. So, Mr. Uncle Mike, there are people out there who don't even know why the heck I call you Uncle Mike. So why don't you give a real quick overview of what your background is in options and what you do over there at St. Charles Wealth Management, sir?
Absolutely, absolutely. Well, what I've been doing is I actually started out trading options. One day, someone gave me a Get Rich Quick CD. At the time, it was roughly 20 years ago. I was a professional football vagabond. I just got cut by the Buffalo Bills, and I was bouncing around playing an old thing called arena football at the time. And I was living in my apartment, and I was thinking, well, this football thing actually might not work out. What the heck am I going to do? Didn't really want to get an office job, even though I did have my degree. Actually, the thought of being in an office all the time kind of stressed me out. It wasn't for me. And so I started trading options while I'm getting cut from various professional football teams. Another job that I did during that time is I was substitute teaching to pay my rent. And then what I would do at the time, I weighed 320 pounds. And so what I would do to get silence in the classroom is I would stand up in the class and basically say what the assignment is. I would say, "You will be quiet. You will not talk." Basically talk like a drill instructor like I did about 5 minutes ago. And so I would have a full day of silence. And that's how I educated myself on option trading. Went great for me to start. I'm pulling in $3,000 or $4,000 a month. And I'm thinking, holy cow, if the football thing doesn't work out, the whole world is dumb except for me, let me tell you. And then I lost $6,000 one day. And then I realized I need to do this thing called risk management. Now, through the years, I definitely did some other things in terms of my career. I worked as a financial service rep for a while. Did really well with that, but I wanted to bring out option trading to the masses, so to speak. And when you're working for a company called MetLife, and I say, hey, how about this covered call? How about a collar? How about this, that, or the other? They really weren't too keen on that. So needless to say, I wasn't working for MetLife much longer. Great company, by the way, in terms of insurance, but it's not really the place you want to be if you want to be doing option strategies for your clients. So I ended up getting a job at Options Express. I was worked up to the director of education there, and I learned so much in that role, just from the standpoint that we would do these joint events with exchanges. And so I used to get to, after these joint events on the road, I would get to just have dinner with or just kind of hang out with these old floor traders that were working for the exchanges. And I could tell them, well, what about this? Does this work? No, that doesn't work, kid. What are you thinking? Or what about this? Oh, there you go. That would work. And so I was able to combine the knowledge that I learned from doing that job and the knowledge I learned from MetLife from the standpoint of financial planning. And in 2011, I went independent in 2009, I went independent as a financial advisor. And a vast majority of my clients have options in their portfolios. And I've been living my dream, so to speak, since 2009. I have the best clients in the world. And what I've been able to offer my clients through a unique past experience is the ability to give them long-term financial planning advice, which I learned in my early days at MetLife, but also the way with which to make it better, in my opinion, by using the option product in a lot of ways. And that's what St. Charles Wealth Management is all about.
There you go. So in a nutshell, Uncle Mike, one of the few financial advisors out there who actually uses options. Not just going to sit you down and say, okay, how old are you? What's your risk tolerance? Okay, 60-40, stock to bonds next. He's actually going to do some stuff, as we like to say, out there for you. So check him out over there at stcharleswealth.com if you are so inclined. As we head on into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
All right, everybody, welcome to Basic Training, the portion of the show where we break down some basic options, concept, or topic, or strategy, and explore it in a little bit more detail. Explain how you can utilize it in your own portfolios. On a recent show, Dan and I explored when to roll, or perhaps not roll, that old standby in the options market, yes, the covered call. We're going to flip the script a little bit and go to the dark side, even though if you understand options and synthetics, you know covered call, short puts, the same thing. If you don't understand what the heck I just said, go back into the archives of this program, look up for some synthetics and things like that where we talk about risk equivalencies out there in the marketplace. Just know from a risk perspective, a covered call and a short put, the same thing. But we explored that. We know a lot of people view these strategies a little bit differently, so we wanted to come back to this topic under a new lens, which is, of course, what do you do with those short puts when you start to approach that strike? Let's go back to our old friend, XYZ. We've all made and lost fortunes out there in XYZ. Hopefully you're all up money in XYZ right now. You don't need to be losing money in your fake trades as well as perhaps real ones out there. XYZ trading for a nice round, a nice even $100 in our scenario. You come out and you say, you know what? Hopefully, if you listened to the show in the past, you've done this analysis and said, you know what? I don't mind buying this stock at the price of 90. So I'm going to turn around and sell that 90 put. And in our example, you get a nice $1 for that front month put. Nice even numbers, nice and juicy, pretty rich actually for a 1 month put out there. $1. But we know practically a lot of you out there maybe say you're doing that analysis, but in reality, let's say XYZ now drops. You sold it, you have 1 month to go. Now in a week later, the stock has dropped to about 95. Those puts are trading, let's say in our example, for about $1.25. They have had some decay come out, but they've also had some value appreciation due to the delta out there. So now, what do you do? What do we do? You're getting closer to your strike. Also, your premiums are ticking up. They're not going in the way you want if you're short. Now, if you've listened to our advice to begin with this show, you've identified a level where you want to buy XYZ, and you don't mind if the stock crosses 90 because you're effectively buying the stock at 89. Remember, you collected $1 to sell that put. But again, we know practically a lot of you out there start to get a little nervous when this underlying approaches your strike, particularly on the dark side, particularly on the short put side. So Uncle Mike, I know you spend a lot of time out there putting on puts for clients, rolling them, adjusting them, taking them off. So first off, in our example here, our little XYZ example, what would you do there? And then B, let's explore a little bit, because I know for everyone it's a little bit different. They have their own kind of methodology. When do you like to start considering to roll a short put? What is your methodology? Is it maybe when the premium moves a certain amount? Is it when you're a certain distance or perhaps at the strike? When do you start considering when to do these things as well, sir? What is your Uncle Mike methodology?
Well, there's a lot to it, actually. If this is a stock, so for example, one thing that we have that we work with, we have our portfolio, we call it the triple income, to where we sell puts to get into stocks. And once we're into the stocks, we'll sell covered calls on them. And then also when we're in it, we'll collect dividends on them because we do this on dividend-paying stocks. And so if it's a stock in that portfolio, meaning something that we want to hold for a longer period of time and maybe actually get to collect a dividend and something where we want to own the stock, then I would do nothing, meaning that I would want to put the stock. Now, at what point do we say, okay, we cry uncle and we don't like it? Well, for that portfolio, something to where you're going to have more of a longer term time frame, I would say whenever there's a fundamental change in the stock, meaning that maybe it's a government defense stock and they lost a government contract, or they canceled their dividend, or when something like that happens would usually be when I would consider not being in the short put or letting the stock not get put to me or something along those lines. So that's where I would do if it's something along like that. Now, let's say it's something to where I'm looking to just collect premium and I have a more short-term outlook on the stock, and I'm just looking to get my $1 every month and move on. Well, my general rule of when I like to get out of things would be whenever the price of that option, regardless of the price of the stock, but whenever the price of that option would go to $1.80, that would be my time to go out. And the reason I say that is because I would take profit when the option would be at 20 cents, meaning that if I sold the put for $1 and I wanted to make money, I would want to get out when I've made 80% of the potential premium available. And 80% of $1 is, of course, 80 cents. Now, on the flip side, what do I do to risk, or what's my risk management? I typically, and I'm not perfect at this, I can tell you from almost 20 years of doing this, it's never going to work out perfect. Because if you think you're going to sell exactly at $1.80, you're probably going to get filled at $1.82, and sometimes $1.76. You never know. But I'm just giving you this from our good old buddy XYZ stock. In a perfect world, I would get out when it goes to about $1.80. Reason being, I like to lose as much as I'm trying to gain. And by doing it that way over time, then I'm going to be a winning trader if I just make more winning trades than losing trades. And that's my general rule for it. If I'm looking to do this as more of a short-term trade. So to answer your question to the downside, in that instance, I would get out when the value of the option goes to $1.80, and I would get out for a profit when the option would be at 20 cents.
Interesting. That's why I like discussing these topics, because everyone has kind of their own approach to this. Like I said, we were just talking about this with Dan on our program not too long ago. He was saying through his, I believe he calls it his smart income system. This is mostly on covered calls, but we know covered calls and short puts, two sides of the same coin out there. He likes to look at when it gets to the strike. That's when he rolls it. And actually, of course, like you were saying, and like I was saying earlier, we think in both of these scenarios, maybe doing nothing is a fine thing. If you have identified this 90 strike at where you don't mind buying XYZ, then you've already done your analysis. And whatever happens after that, barring some extreme meltdown in the underlying that changes your outlook completely. Outside of that, you've already done your analysis and you're going to buy this stock out that level regardless, or you're going to keep your $1. I'm curious, Uncle Mike, do you do that same analysis then for covered calls as well? Is it that roughly 80% premium guide, or do you use a different metric on the covered call side?
To the downside. So let's say that I'm selling an out-of-the-money covered call and the stock stays the same. I would get out of the covered call at an 80% of the potential profit. And if the stock were to pull back a little bit, roughly 80%. Roughly when I can get to 80% of the premium that I initially sold. The analogy that I like to use with that is that if you take a wet towel and you squeeze it, you're going to get a lot of the water out of that towel. Squeeze it over the sink, of course, kids. Don't squeeze this on your mom's kitchen floor or your wife's kitchen floor, depending on whose kitchen floor you live with. But when you do that, you're not going, no matter how hard you squeeze that darn thing, you're not going to get all the water out of that towel. Meaning, no matter how much volatility comes out, no matter how much the underlying moves in a direction, you're not going to get all of it out. There's always going to be some annoying little bit of dampness in that towel, no matter how hard you squeeze. And so I think it's just not worth fighting for to get that last 20%. So I just move on and find another wet towel and try and squeeze that.
Now, one of the problems I have with using premium as the metric for when to get out of these short type trades like covered calls and short puts, it is a bit of a moving goalpost, right? We talked earlier about the decay. That's going to impact your premium. Your volatility is going to impact your premium. Of course, the movement in the underlying is going to impact your premium. So you're constantly going to be approaching and then moving away from that 180 metric that you put out there earlier. Whereas one of the things I agree with Dan on is just it's nice, particularly for early and new options traders to come in to have a very fixed goalpost, a very fixed end zone that they have to look at, which in this case is the strike. So if you get all the way to the strike that you sold, maybe then you consider rolling it or taking it off. And the same thing on the covered calls. At least that way, you know, if you're a newcomer, you're not really that certain maybe about how the Greeks work, and you set this, whatever your premium level is. Let's say in our example, you go for this, the 150 or 180, as Uncle Mike said earlier. Then, of course, you get close to that. Then you wait a day or two, nothing happens, and the underlying, some decay comes out. You drift away from that, but you're still at a similar relative strike level. That could be a little bit confusing. So that doesn't ever muddy the waters for you, Uncle Mike, the fact that obviously the premium is ebbing and flowing all day long versus the strike being a very fixed goal line. I know you like football, sir. You like a good football analogy. How do all those moving parts work together in the Uncle Mike philosophy, sir?
Well, in the Uncle Mike philosophy, I guess I'll make it real easy for this show. The two ways with which we do it, the first method to where we just own the stock and do nothing, I would say 95% of the covered calls or short puts that I trade go along those lines. And so on the same side with a covered call, usually what we'll do is I'll get out of it at the 80% rule for a profit. And if the stock just goes up, I'll just let it get called away and rinse and repeat. So I would say 95% of the time, I'm doing it the easier way.
And you find that helps with maybe new clients too, who are new to options, and maybe you just help them explain these relatively fixed goalposts, and that helps them kind of understand what you're doing? It's
much easier to do it that way. It is much easier to do that way. And I would say, and that's how I do it 95% of the time. The 5%, I just wanted to give you everything that I do, me being the full disclosure kind of guy with which I am. But no question, it's much easier, much simpler. And it's definitely a much easier way of going. And if you're a beginner to something like this, I would highly recommend doing it that way.
And let's talk about your process for rolling. Now, we've already established that you should probably establish this at the outset and probably consider not rolling. If you have done your real due diligence, if you're honest with yourself, that's the level you want to buy the stock in the short put scenario. But let's say you put this on as an income trade. You're doing the more, as Dan would put it, the more speculative type trading out there. And you get close to the strike, or maybe you hit it, or maybe you do the Uncle Mike example of getting 80% of the premium there, and you decide to roll it. What is the Uncle Mike methodology for rolling? Do you go out a specific set amount of time? Is it just 1 month? Let's say in our example, you're doing the 1 month put. Would you repeat that again? Do you go out into the weeklies? And also, how far out do you roll it? What is the Uncle Mike methodology for that?
Well, that one's kind of a moving target as well, from the standpoint that if I've made up my mind that I don't want to own the stock and I just want to get this as like a quick income type of thing, the way that Dan describes it, then I have kind of like an alert or a line in the sand to where when it gets to about the 180 level, and I can usually calculate that based on the price of an underlying and based on my estimate of where volatility is going to be. So let's say we're an XYZ stock, it's at 100. I sold the 90 put. I know that as soon as I see that stock go to 94 or 96 or whatever I calculate it out at, that's when I got to get to the point of like, hey, that's the, hey, what am I going to do point, or my line in the sand, so to speak. And so at that point, what I'll do is I will look to do one of three things. Thing one, hang on because there's only 1 day left till expiration, and I'm willing to take that ride for another day, let's say. Number two, just get out there because of the fact that the stock has broken some type of technical level, or I don't like this anymore. It's time to go somewhere else. Or scenario three, what I would then do would be roll it. And that's kind of what the basis of this question would be. And at that point, I look to see what is the best deal. That's when I'm going shopping. Is it best off to, if I roll it down maybe to the 85 put and I can stay within the same 1 month expiration? You know what? By doing that, the difference in the strikes is maybe only 30 cents. Well, if that's the case, I want to get my income now, and I'm willing to give up 30 cents for that extra $5 worth of cushion. Or I can do the down and out roll, meaning for even money, I might be able to buy to close that 90 put for $1.20, $1.50, $1.80, whatever the case may be, and I can sell an 85 put 2 months out for $1.80 because of the fact that I'm still getting the same amount of income. Everything's the same. I still have the same amount of money in my portfolio, and I have another $5 worth of cushion. But the downside is I got to wait another month to get that income. So I like to, those are probably the two things that I like to look at. I prefer, if it's possible, to just roll down that same month and then sacrifice some money to do that. But that doesn't always work out so well, or that's usually not there. But that's my dream roll down should such a thing happen. But if it's not there, then I would look to the down and out roll.
Interesting. So you will roll to the same month. I know some people sometimes will only roll out and give themselves a little bit more time, but you're looking first and foremost to keep it in that same expiration cycle, sir.
Doesn't happen. I would say maybe whenever I am at a point where I do decide to roll, I would say I'm able to do that for what I would consider a good deal, maybe 30% of the time at most. But I always look for it because that's my preferred method, because then the following month I get to start the process over again and be at a profit.
Yeah, it's kind of hard to find those good deals in that same expiration month. Usually if you get to that point where you're getting a good amount to roll down, the put you have to buy it back is so expensive that it makes it challenging. Before we get off rolling really quickly, I know you also have a methodology when it comes to rolling, which is you're not going to keep rolling forever. You're not going to keep this trade going forever. What is your cutoff point when it comes to rolls, Uncle Mike?
If it's on a stock itself, I would say, like I said, probably 95% of the time, I'm just simply owning the stock. And I would just say it. But if I'm looking for quick income or something along those times, usually after 2 rolls, I would say, and I don't have a hard and fast rule in terms of when I would stop, but if after 2 rolls down, I better have a darn good reason for wanting to be in this thing that's made me go to the well twice and lose twice.
Yeah, 2 rolls and done. Some people like to say just one and done, but whatever it is, have some guidance at the outset, listeners, in terms of, we've seen so many people reach out to us, and they had some idea at the outset of their trade. It could be a short put, could be long straddle, could be whatever it is they wanted to do. And then whatever they had on didn't go their way, and they start rolling. They start adjusting. Next thing they know, they send us a position that has 15 different legs, and it's all over the place in terms of months and strikes, and it's impossible to make heads or tails of what the heck they're actually trying to do. And they just got into this rolling and adjusting frenzy. At the end of the day, they did nothing but pretty much generate some commissions for their brokers and probably lock in some losers for themselves along the way. So definitely, when it comes to having a plan to putting these things on, if rolling is part of that, if you say, I'm going to get to this strike and I'm going to roll it, make sure you have some sort of plan there. Don't just keep rolling ad nauseum forever, because that way lies madness. That way lies a whole bunch of losses in your future. Cut yourself off at a certain point. Say, okay, obviously this is not working out. We need to adjust that. And that could be whatever your frequency. Uncle Mike likes two. Some people just like one roll. If it went against you once, okay, fine. Second time, don't let it bite you again. Definitely have a hard and fast roll. Speaking of being hard and fast with rolls, Uncle Mike, I know some people like to set this up at the outset. They say, you know what, I want to sell this put, but maybe I'm going to give myself a little bit of wiggle room. Maybe I'm not right. Maybe this thing actually has more downside to go. In which case, I'm going to cover myself, and I'm going to sell a put spread instead of a put. So maybe in our example, instead of just selling the 90 put outright for $1 in XYZ, you turn around and buy the 85 put, maybe for 50 cents in our example. So now instead of selling the 90 put, you've actually sold the 90-85 put spread, and instead of collecting $1, you've collected 50 cents. What is your thought process on this approach, Uncle Mike, and do you ever utilize short put spreads instead of just short puts?
All the time. And I think the number one thing, before we get into this, when comparing the two, for all you listeners, get your pens ready, write this down. I can write this down, people, or so whatever, if we're in the boot camp concept. I think the most important thing is, what do you do with those other $85? If you are using those other $85 to sell more and more put spreads and use more and more maintenance, bad idea, because of the fact that you're creating levels of leverage you did not initially intend for. If you're just taking those other $85 and putting them in cash, a government treasury, a CD, a bank account, or whatever, then it's a more conservative trade. However, if you're taking those $85 and doing more trading, if you were to use those other $85 and do another 17 put spreads, I did the math in my head real quick. I got lucky. Maybe I'm right. Maybe I'm wrong. I don't know. But if you use those other $85 to do all those other put spreads, then you're going to make a lot more money if you're right. But if that stock goes down to $84, you're going to lose 100% of your money, as opposed to losing $5. So I think the most important thing to do is have an understanding of what you're going to do with the rest of that money. What I do all the time, I have a levered portfolio to where I'll do something along those lines, selling a put spread, just the way that you described it, Mark. But with those other $85, I have that in government treasuries, into like an IEF that I'm selling covered calls on, or something along those lines, to where it's fairly safe. Or if I want people that want to have a little bit of leverage in their life, then maybe I would do 2 put spreads and have the other $80 in government treasuries or cash, or something boring, so to speak. So I do like that strategy, and my simulated index concept strategy does a lot along those lines, primarily more so with put spreads than puts, quite frankly.
Interesting. So obviously the pushback we get whenever we discuss that a lot here on the show, Uncle Mike, is, but I want all that juicy premium. I want my full $1 in this case, as opposed to 50 cents. What do you say when maybe a client comes back at you and says, why are you selling the put spread? I'm only getting half my money. What is your rebuttal to that, sir?
Well, I think what you need to do is just have the understanding to where if it goes against you, then you'll lose a lot more if it goes all the way down. So let's say my school of thought is that I can find another way to make 50 cents, most likely. In that with that other $85, I can find some type of interest-bearing something that I feel is more safe than having $85 worth of downside risk. So I think that's the way, that's kind of my philosophy. And then if you do want to leverage yourself a little bit, like I said, we can do that. But I think there most of the time and it depends on your situation. It depends on your tax bracket, depends on what your financial situation is. But a lot of the time, I think that I can find a better way to help you make the 50 cents than taking $85 worth of downside risk.
So there you go, listeners. A little bit of an overview, a little bit of a refresher. This is the topic, obviously, we've touched on in the past. Go check out our archives there for short puts and income trades. We've discussed this in many different flavors over the years. And it's also interesting to get different people's perspectives on this because different people have different risk metrics, different risk tolerances, and different use cases for options. But let's just roll it over really quickly because we know there's new listeners joining us all the time here. In our example, of course, XYZ trading 100. You sell that 90 strike put for $1. Now you have many different scenarios. What could happen? The stock could rally and you keep your $1 and everyone's happy. Or you could drop a little bit. And when it starts dropping, when that premium starts ticking up and the underlying starts getting closer to that strike, that's when usually the worry sets in. That's in, what do I do? What should I do now? And hopefully you've listened to our advice and you had this plan at the outset and you've decided you wish to buy XYZ. Using short puts as a way to get paid to get long equities is a perfectly viable and indeed desirable use case. If you're out there all day just working limit orders in the underlying stock anyway, if you're working limit orders in whatever the stock is, Apple, Google, Facebook, whatever the heck you're trading out there right now, then you're already taking risk in the marketplace. We've learned many times. Limit orders to buy a stock, that's risk. You could get hit. The stock could blow right through that and vice versa. You should be compensated for that. So at the very least, you should be using options for that use case. In this case, if you want to buy XYZ, you should be selling the put rather than working the buy order because you should be compensated for that risk. Just understand that going in, you're going to buy that stock at 90 or in this case, an effective price of 89 because you collected $1 to sell that put. And you should be okay with that at the outset. If you're not, as my cohort there on the option block says all the time, the Rock Lobster, decide on a strike first, then maybe you adjust it down a few strikes, just in case. Maybe in this case, you sell the 85 put for 50 cents instead of the 90 put. And then you're going to be certain when you get there, you're going to be comfortable buying the stock. That's what you should do at the outset. Make sure you're going to be comfortable getting the underlying. If for some reason you're not, or if for some reason you want to get into more of the harvesting type strategy, then you need to have a methodology in place for when and how you're going to roll it. We just explored a few scenarios for you there with Uncle Mike, including ways to do it. We like to keep things simple usually on this show. So moving towards the strike and getting at that strike is usually a good time to roll that. We discussed that with the covered calls recently on the show. You can use that same methodology for the puts. If you feel a little bit more savvy, a little bit better understanding of options, you understand the Greeks and how they impact the price, the delta, gamma, theta, vega, all that other fun stuff, then you can also go the Uncle Mike maybe 201 route and use the premium movements to come against you. In his case, his barometer was 80%. Just make sure you have that clear, hard and fast rule set at the outset so you know how you're going to do it. And try to limit yourself when it comes to rolls. Don't keep rolling. One, maybe two, if things are really going crazy and you see some good scenarios out there. But rolling endlessly, that's just a way to keep locking in losses over and over again. Uncle Mike, we talked a lot about short puts. Any other pro tips or nuggets you want to leave our audience with before we answer a few of their questions, sir? Don't
over leverage yourself. Over leverage is the number one thing gets people out of this business and out of trading. Mark, I've been around doing this for almost 20 years. I know you've been around for about the same amount of time, maybe a little bit longer even. In my time, I've never met anyone who has consistently made money levering themselves as much as they can. So in other words, with that 90 put that you sold, unless it's an IRA, you have the ability to sell that with roughly $25 in your account. And so, yeah, it works well when it works, but the one time it doesn't, you typically blow out. And so I've never met anyone who has levered themselves that much that has stayed consistently has made money. Have you?
It's a dangerous road to go. You really have to understand what you're doing. As we said here many times, particularly for this scenario, this strategy, the short put, if you're just doing it to harvest and you're not comfortable buying the underlying there, then you need to have plans because this is a strategy that works until it doesn't. And when it doesn't, it can go against you pretty badly. Most people, when they blow out, it is for not really understanding or having a good plan in place when they're utilizing this specific strategy. You don't see people blowing out as often on the premiums, long premium side. You can, obviously. It's more of a death by 1,000 cuts versus the short premium side where it's going to blow up against you very hard. That's why we encourage you at the outset to have hard and fast rules when you're initiating these trades, because that'll make your life so much easier. If you're okay buying the stock, then you're good. Then there's other things you could do. Uncle Mike talked about the wheel trade, or as he referred to it, the triple income strategy. Once you have that underlying in your possession, there's things you could do. You could wheel out of it with a covered call. You get paid to get in, you get paid to get out. If you want to learn more about that, check out Uncle Mike, his triple income strategy, or check out our archives. We call it the wheel strategy there. It's been in there a few times under income trades and under the wheel strategy itself. So there are things you could do. You're not just stuck with this stock and have to just wear it forever. But at the outset, particularly when it comes to these short premium type trades like short puts, remember, you're looking at it from the dark side there. There's a lot that could happen on the short put. So have the plan in place, because this is a strategy that works until it doesn't. And then the one time you sell this put, maybe you do it every month, you make your buck. Then one time it blows through your strike by $10. What are you going to do in that scenario? What can you? If you're comfortable owning the stock, then you're good to go. You got the stock at a nice discount to where it was trading when you put that trade on. But make sure you have that plan in place. Maybe it is if you're not that comfortable. Maybe it is selling the put spread rather than just selling the put. Maybe it is putting your trade on at a lower strike so you are comfortable buying it there. And if you have to roll it, make sure you have that plan in place. Again, this is a strategy that can work until it doesn't, so make sure you have a plan in place for what happens when it doesn't. All right, interesting stuff. We could discuss this for pretty much many shows, and we have. So go back, check out our archives. I'm sure you guys have questions about this. Hey, when should I roll with this? I have XYZ position on right now. When should I roll it? Hit us up with all that stuff. We don't mind answering your questions, as we're going to prove right now with a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you guys take the reins, your questions, your comments. You guys deluge us with questions. We try to answer as many as we can. Like I mentioned at the top of the show there, these are troubled, difficult times for a lot of people, so I like to kick things off with a little bit of love. This one comes from PSTU7. I'm not sure where they left this one, but our stuff's available on a lot of platforms these days. But it's a 5-star review from PSTU7 saying, just discovered this show. I wish I discovered it ages ago. I'm starting from episode 1 and binging all the way through. If you're reading this, then stop and go subscribe to this podcast now. You'll thank me and these guys as well. Well, we thank you, PSTU7, and everyone else out there who took the time to rate us on your platform of choice. It does help new people continue to discover this program, which, as we've all seen, so many new people flocking to options these days. They need sometimes an experienced hand to help guide them a little bit, maybe just talk them off the ledge in certain scenarios. So we're here for you. Thank you, PSTU7. Everyone else out there who's leaving the love on your platform of choice. I see it out there. You guys are quite nice. We appreciate it. All right, next up, Nancy. Nancy wants to know, are there times when the options have more volume than the stock? What happens when that occurs? Are the stocks delisted? Could that ever happen in a big name like Apple? And what are the implications? Well, a lot of questions there. Nancy, can that happen? Yes. Usually it happens in less liquid names, as you might imagine. Doesn't happen as frequently in big names like Apple, because Apple trades a lot of underlying, too. It's a very liquid underlying. And there also could be interesting times where maybe you could have periods of illiquidity in larger names where, for whatever reason, the size displayed a little bit on the options might be a little bit more than the underlying. But usually those two things are linked, right? Because at the end of the day, the market makers have to hedge their deltas in the stock. So if the stock isn't there, if the stock isn't liquid, you will see that reflected in the spread and the size available on the options out there. So they're derivatives, and they're called that for a reason. The liquidity and the value of one is derived from the other. So if the liquidity isn't there in the underlying, it's kind of hard to magically create liquidity in the options. That said, there are periods, and usually, again, it's in less liquid names, where something could happen, some big trades could go up, and you could see more notional volume being transacted in the options than you do in the underlying. It's very rare to see a pure one-to-one. I think they just say volume, so more contracts than shares of the that would be a weird thing, because, as you know, most equity options are for 100 shares, so you're talking a 100 multiplier there. So if that were the case, that's a lot more size going up in a particular option usually than there is in the stock. That's a rare scenario, but it can happen. Will they be delisted? That doesn't mean they'll be delisted. That just means the volume is kind of light. If the volume shrinks to kind of nothing in that underlying, then yeah, they probably will eventually be delisted. But in this case, just because the options are doing a little bit more, it doesn't mean the stock is going to be immediately delisted. Uncle Mike, any thoughts here for Nancy? Wants to know what are the implications of a name you're trading where the options are more liquid than the underlying? And have you ever encountered this in your trading career, sir?
I have not. I think that if something like that ever would happen, something either information to you has been delayed in some way, shape, or form, or it's something that probably isn't liquid enough to where I would want to even be messing with it, or too liquid in the option space to where I would want to be messing with it.
Yeah, it's kind of a weird, aberrant scenario. Uncle Mike is right. It's probably something you don't want to be trading if that is the case. But again, it's called a derivative for a reason. The liquidity and the value of one is derived from the other. Market makers aren't magicians. They can't manufacture liquidity where none exists. If they can't lean on the stock to get their hedges off, then you're going to see that reflected in the spreads, which will be wider as a result and show less displayed size. So if it does happen, it would be kind of a momentary thing, and eventually you're going to see those two kind of even out. But if it does happen, usually it's going to be in some more esoteric, less liquid names. It would be weird to see it in an Apple. But again, 2020. Anything could happen. All right, next up, Lines Up. Maybe Lines Up? Let's go with Lines Up. Lines Up wants to know, I've heard you refer to Rho as the red-headed stepchild of the Greeks. Why is that? Well, you're right. I do call it that. The primary Greeks we always talk about, Delta, Gamma, Theta, Vega. Those are kind of the big four. Those are the ones that kind of get you in the door, get you really prepped and ready to embark on an options trading career. But Rho is in there. Rho is one of the primary Greeks out there. If you're not familiar with the listeners, go check out the legion of episodes we've done on the Greeks, or check out Dan's book on trading options Greeks. Effectively, it's the Greek that shows you the option prices sensitivity to interest rates. And once I say that now, you should probably realize, well, it doesn't get a lot of coverage, a lot of play. The environment we're in right now, clearly not a lot going on in rates in the near future. The Fed has already come out and said, hey, we're going to keep rates very low for quite the foreseeable future out there. And also, in general, rates are usually one of the more stable inputs to your Black-Scholes model. Things like volatility, other things like that, they could be a little bit more in flux, but rates are going to be generally similar. You might have a little bit better borrow rate here or a little bit better lending rate there for a large firm versus a small firm, things like that. But in general, the overall rates are one of the more stable inputs into an options price, so you don't really see a lot of flux or change in that. But I have said, Uncle Mike, before, I have joked with you that maybe when I think you even have a Rho webinar in your back pocket ready to go. And when it comes time for that, when people are hearkening for Rho again, maybe it's a sign that things are amiss in the broad economy. What are your thoughts here on Rho, the red-headed stepchild of the Greeks, Uncle Mike?
Well, until we have interest rates, it's really not going to matter that much. I mean, the ultimate way with which I would describe Rho is a lot of times that if you have, let's go back to the covered call short put example, oftentimes the short put would cost, let's say you're doing both of them exactly at the money, so that means there's no in the money value on either the call or the put. If we were doing the 100 call and the 100 put, going back to your example, a lot of times the 100 call would be at $1.10 and the 100 put would be at maybe $1. I'm just making up numbers, but the reason is that you don't have that as much of a maintenance requirement in your account. So if you have the short put, you can use some of that excess cash to put money into a government treasury or something along those lines to make up for that dime. So that's oftentimes the case. But right now, because interest rates are so pretty much non-existent in a lot of cases, there's really not going to be that much of a difference in it. And so at this point, I would say Rho's kind of a non-factor. But when we get some interest rates back, I think it'll be more of a factor.
Yeah, at the end of the day, the Greeks that are more, interesting to people out there, the ones that have a more direct impact on the options price and are changing and moving around quite a bit. So it has to take a lot to really grasp them. Theta is obviously a big one. Time decay, obviously volatility is a big one. Delta is, of course, what brings a lot of people to the option space. To begin with, they want that directional exposure. And then they learn about gamma eventually and what that means to delta and things like theta. But Rho, again, as Uncle Mike said, is kind of a stable input and it's very much a non-factor right now. So for the time being, Rho, I think, will remain the red-headed stepchild of the Greeks. And if that changes, That means a lot has changed in the broad economy. It might be an interesting time for trading out there. All right, next up, Matt. Matt Tens says, I've heard rumors that Robinhood traders are completely driving the options market now. Is that true, or is it true that this is the source of most of the new volume, or are there other factors at work? Well, yes, that has been a big headline of late. Look at the impact of the Robinhood traders out there and how they're driving so many of these stocks to new all-time highs. Clearly, there are other factors at work. You can't really get big market moves without the big institutional players coming in and driving these things as well. But it is also true that Robinhood is a big factor in what we've seen. We've seen this explosion of retail. And it's not just Robinhood. It's all the retail brokers out. Everyone just uses kind of Robinhood as the synonymous, Kleenex effectively for the retail options trader. And usually probably the less informed, less knowledgeable, very basic options trader. And we have seen, partly because Robinhood is reporting their numbers for the first time this year, so we have a little bit more insight into that side of the space than we did a year or two ago. So that's helpful. And so people are seeing these numbers, and they're also seeing what they're doing. They're flocking to options because they don't have a lot of capital, and they want to use the leverage side of options. And what are they doing? They're mostly buying calls in big names like Apple and others for a variety of reasons. They can't afford the stock. They're super bullish, maybe all of the above. And so there does seem to be a unidirectional nature to the options flow over there at Robinhood. And it is definitely contributing to very much the steep level of volatility skew we're seeing, particularly in the calls in names like Apple and others. We had our friend Matt from Oratz on the network not too long ago saying he's never seen the call skew steep in Apple than it is now, and all the time that he's been tracking that. And that's undoubtedly a lot of that driven by the bulls in the Robinhood crowd who are buying up these calls en masse. So are they most of the new volume? I'm not going to say most. A large chunk of the new volume is certainly these, and also the fact we're in a pandemic right now, Matt. So that's, of course, inflated volatility. Higher volatility usually translates to more options volume for all of the reasons we've broken down on this program in the past. And we have seen that translate into very, very large numbers. In fact, pretty much every month this year has been at or close to a new record for the OCC. And already by September, OCC has already had the busiest year of its life. OCC, of course, the Options Clearing Corporation. People will take the other side of all of your options trades out there. So they should know how many contracts are going up. And already through September, they've already beaten the previous highest year in options market history, which was back in 2018. So if that's the case, we've already blown past the whole year of 2018 by September. We are certainly on pace for some record numbers. And yes, the Robinhood folks and all of their ilk are a big part of that, but they're not by any means the only reason. A lot of things are out there driving a lot of volume, a lot of volatility, and as a result, a lot of paper out there this year. Matt, 2020 is just one of those crazy years. All right, next up, we've got, I like this handle, Hardware Guy. Hardware Guy wants to know, when do you choose to leg out of a spread versus taking off the whole enchilada? Danks. Well, I like that, danks. The whole enchilada. Uncle Mike, I know you're a guy who does a lot of adjusting of your various positions. What is your thought process on this? Do you come in and take off the individual legs? Do you take off, as he puts it, the whole enchilada? And how do you choose which to do?
I never want to, but the only time I ever would if there's a liquidity issue, meaning if I'm a retail trader, if I'm trading my own personal account and I have a 10 lot, the answer is never. Well, I guess there would be one specific instance, which I'll say in a minute. But on the institutional level, when I'm trading lots and lots of money and lots of contracts, sometimes I have to for liquidity issues, but I never enjoy doing it ever. I can assure you of that. The only time I ever would get out of it individually, an individual leg, would be if, let's say, I sold a put spread and the stock went so much my way, it gapped up overnight, let's say, and I could just get out of the short put for a penny, I would. And then I would just leave that other long put on as like a free lottery ticket. And I would say maybe once every 4 or 5 years, the stock will just go against me again, and that worthless option becomes worth $4. And so it happens about once every 5 years, so I don't count on it, but you never know. But that's the only time I do it. To me, the purpose of getting in a spread to begin with is because you want to mitigate risk in some way, shape, or form. And by legging out of it, you're taking away the whole point of getting into it in the first place, in my opinion. So short answer, never. Long answer, on occasion.
That is a very widely held philosophy. You put the trade on as a spread, as a single unit, take it off as a spread, as a single unit. That certainly is applicable and easy for most people to do when it's a vertical. So it's usually done in the same expiration month, usually with the same type of directional momentum at play. This gets a little bit more tricky, Uncle Mike, when people start putting on these spreads that have a little bit of play in both directions, right? So let's say a straddle or an iron condor or an iron butterfly, these things that have both a call and a put component. So very frequently what happens is it'll start moving in one of their directions, and one portion of that spread will be doing very well. The other one, not so much. So I know you're not a huge fan of those types of spreads, but what about in those scenarios, Uncle Mike, where you have these both call and put components that usually tends to trip people up a little bit more? What do you do in those scenarios?
I don't do those scenarios personally. I'm kind of the eternal bull, if you will. But I think in that instance, I would make every effort to try, and if you have to adjust, maybe add some deltas or take away some deltas. Oh, okay, that's fine. That's one thing. But typically, if you're just doing a vertical, I recommend trying your best. If you can't, you can't, but trying your best to get into and get out of it at once. But if you do have some type of a multi-directional trade, then I would say you just adjust as needed, meaning if you're trying to stay delta neutral on a straddle, maybe close out one of the 8 puts that you're in and leave all the 7 calls that you're in on, or something along those lines. But typically, I like doing them all at once.
Yeah, I think particularly for the audience of this show, that is a good rule of thumb to live by, which is you put it on as a unit, take it off as a unit. Otherwise, you start taking it off piecemeal, you're going to dramatically change the risk factors of that spread and that trade. And that's maybe something you're not prepared to handle or deal with. So definitely for the audience of this show, put it on as a unit, take it off as a unit. You get a little bit more sophisticated. You start doing a little bit more multi-leg type strategies that offer and that do involve, calls and puts and multi-directional type plays within the same trade. Then it gets a little bit more nuanced. But even in those scenarios, the lion's share of the time, you're probably going to want to take it off as a unit. So avoid getting in trouble. Put it on as a unit, take it off as a unit. Who wrote that in? That was from Hardware Guy. So a good rule of thumb, particularly when you're starting off in options. Keep it all together. Otherwise, down that road lies madness. We got time for, let's do one more. Let's be nice. Let's go to this guy. I like this guy's handle. That's probably why he got on. Max Carp. He's going to carp us to the max. I like that. Max Carp wants to know, what's better, tighter spreads but for less size, or more size on the bid offer but wider spreads? This kind of gets back to that question we had earlier about the liquidity in the options versus the stock. This is kind of a little bit of a false comparison here, because at the end of the day, if you have a tight spread but it's not showing you much size, like we see that now in some of these names. So they may display a bid and offer that isn't really real, but it looks tight. You might say, the spread for this is only a few cents wide. That's great. Then you click on it and you see that the actual displayed size is only maybe for 5 or 10 on the bid and 30 on the offer, something like that. That's really not going to get you done for much. So at the end of the day, that's not the real market. That may be what's getting displayed. That may be what's called the NBBO, the National Best Bid and Offer, which is aggregated across all the best platforms. And that technically is correct. That is the quote-unquote best bid and the quote-unquote best offer there in terms of tightest. But it's not the real market. Obviously, the real market is going to be a few cents or maybe more outside of that. We see this all the time on our show, The Option Block, where we're profiling unusual activity. All the time, there might be a displayed bid for, let's say, 50 cents, and someone wants to sell a call there 10,000 times, and they actually have to sell it for, let's say, 46.5 cents, something like that, through the bid, because the real bid wasn't there. Not at 50 cents, at least not for the amount of size that they wanted to do. Now, you're not going to go and do 10,000, I'm guessing here, Max Carp. But if you're seeing these very tight markets and they're only displaying a few on each side, then that's not the real market. The real market is outside of that. And that's driven by a lot of the factors we just discussed. What kind of liquidity is available in the stock? How much volume is going up in the options themselves? All these things are going to be reflected in the spread you're seeing out there. So sometimes you might see a really cool, tight NBBO, and you go try to hit it for 10, and it's not there. So nice displayed tight market isn't really that useful if you can't hit it for your desired size. Mr. Uncle Mike, anything you want to add here for Max Carp, sir?
No, not on that. I think that it is important to have an understanding of where you're at. It's similar to the debate over whether you should sell a put or do a put spread. I think it just depends on what level of leverage you want to be at as well. So, but understand that when you're doing this and you see the NBBOs of spreads, it may not necessarily be what you get filled at, like you said.
Indeed, we can do a whole another episode on NBBOs and single leg trades versus spreads. Maybe we should do that because there is a lot of confusion out there. Unfortunately, listeners, that music means we've come to the end of this journey through the old Options Bootcamp Drill Instructor Proving Ground. Gave you your full hour here. You guys have been asking for longer, meatier episodes. Uncle Mike and I, once we get together, we can't stop talking options. But before we go, Mr. Uncle Mike, if folks are intrigued, maybe they have more questions about rolling these puts and things, and they want to hit you up over there in the land of St. Charles Wealth Management, where should they go? What should they do?
stcharleswealth.com. There's the Contact Us button on the site. You can learn a little bit more about what we do. I'm a financial advisor, a very traditional one from the sense of financial planning, but I would consider myself rather untraditional in terms of the way with which we view the markets.
There you go. He's untraditional. Check him out for yourselves, stcharleswealth.com. And, of course, the black-hatted one couldn't be here today. Check him out over there at markettaker.com. 2 T's. Market Taker. Click on the membership button. You can join up there, have the live chats, all that fun stuff. And on behalf of myself and the uncleist of Mikes and the black-hattest of ones, a.k.a. Mr. Passarelli, I thank all of you out there for downloading, streaming, subscribing, for sending in those questions. Keep them coming. Love to hear. If you remember, if you like what you hear, keep those reviews coming in your platform of choice. And we'll see you back here next week for another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.